How do you know if the trend of your stock or commodity is up or down or sideways? There is a mathematical way of telling it. I'd like to share that with you today. There's so many ways of looking at trend, but the simple one I developed years ago, and you can put it on all of the software you have, is simply a 50-day moving average. If price is above a 50-day moving average, or that 50-day moving average is an uptrend, assume that the trend is up. If it's in a downtrend, then assume the trend is down. In a downtrend, that means you would want to be taking short-term sell signals. In an uptrend, you can take all the buy signals because then you will be trading and you'll be investing with the trend. The trend is your friend. Stay with it, use a 50-day moving average, and you'll know the real trend of the market.
That is the foundation of today's lesson. Before you can use continuation candlestick patterns correctly, you first need to understand the direction of the market. When the trend is unclear, the pattern loses context. But when the trend is clear, continuation patterns can help you identify moments when the market pauses, builds strength, and prepares to continue in the same direction. Hello traders, welcome back to the channel. In today's lesson, we are advancing further in our course, Technical Analysis for Day Traders, from Basics to Advanced, by studying advanced continuation candlestick patterns. If you have been following along, you already understand the foundation of candlestick patterns and how they help reveal market behavior. Today, we are focusing on continuation patterns, powerful tools that help confirm when a trend is likely to keep moving in the same direction. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So, let's begin by discussing what continuation patterns actually are. They matter in technical analysis because they suggest that the current market trend is likely to continue. Whether the market is moving higher in an uptrend or lower in a downtrend, continuation patterns show that the prevailing momentum remains active. In other words, buyers or sellers are still in control, and the market may keep moving in the same direction after a brief pause or consolidation. These formations can appear several times within the same trend, especially in moments when the market slows down before continuing. While they don't always signal an immediate breakout, they often appear before strong moves in the same direction. That's why they help traders confirm that the trend is still active, instead of exiting too early or trading against the main direction. Understanding these signals allows you to stay in profitable trades longer, re-enter with more confidence, and avoid closing positions too soon. This becomes especially powerful when the pattern appears early in a trend, because it gives you a strategic edge in trade management. To make identification easier, tools such as candlestick pattern indicators on TradingView can help highlight these formations automatically. This can save time, reduce errors, and support faster decision-making as you refine your strategy. Now, let's start with the first pattern, the rising three methods. Structurally, this pattern forms during an uptrend when a large bullish candle is followed by three smaller bearish candles, all staying within the range of the first candle. Finally, a strong bullish candle closes above the high of the first candle, confirming the continuation of the uptrend. The psychology behind this pattern is that after a brief consolidation, buyers regain control and show that upward momentum is still intact. To trade this pattern, the most effective approach is to wait for the final bullish candle to close above the high of the first candle. This confirmation signals that the trend is likely to continue and can provide a potential long entry. Next, we have the falling three methods. This is the bearish version of the rising three methods. It appears during a downtrend when a large bearish candle is followed by three smaller bullish candles, all staying within the range of the first candle. The final candle is a strong bearish candle that closes below the low of the first candle, confirming that the downtrend is likely to continue. The The psychology behind this pattern is that even though buyers briefly attempt to regain control, sellers reassert dominance and push the market lower. To trade this pattern, wait for the final bearish candle to close below the low of the first candle. Once confirmed, a short position may be considered to take advantage of the continued downward momentum. Now, let's look at the bullish mat hold. This pattern begins with a large bullish candle, followed by a gap up and a series of smaller bearish or neutral candles that remain within the range of the first candle. The final candle is a strong bullish candle that closes above the high of the first candle, confirming the continuation of the uptrend. The psychology behind this pattern is that even after a brief consolidation, buyers quickly regain control with strong momentum. To trade the bullish mat hold, wait for the final bullish candle to close above the high of the first candle. This confirmation signals that the uptrend may continue and can provide a clear long entry. On the opposite side, we have the bearish mat hold. This pattern starts with a large bearish candle, followed by a gap down and a series of smaller bullish or neutral candles that remain within the range of the first candle. It ends with a strong bearish candle that closes below the low of the first candle, confirming the continuation of the downtrend. The psychology is that even though buyers attempt a brief recovery, sellers regain control and continue pushing price lower. To trade this pattern, wait for the final bearish candle to close below the low of the first candle. Once confirmed, a short position may be considered to follow the continued downtrend. Now, let's move to the bullish Tasuki Gap. This pattern forms when a gap appears between two bullish candles during an uptrend. The third candle is bearish, but it does not close the gap. This confirms that buyers are still in control and that the uptrend is likely to continue. The psychology behind this pattern is that although sellers appear briefly, their inability to close the gap shows that bullish momentum remains strong. To trade this pattern, wait for the third bearish candle to hold the gap without closing it. Once confirmed, entering a long position may be a reasonable strategy to follow the continuation of the uptrend. Next, we have the bearish Tasuki Gap. This is the bearish counterpart of the bullish version and appears during a downtrend. A gap forms between two bearish candles, and the third candle is bullish, but fails to close the gap. This confirms that sellers remain in control and that the downtrend is likely to continue. The psychology behind this pattern is that even though buyers try to fill the gap, their failure to do so shows that sellers are still dominant. To trade the bearish Tasuki Gap, wait for the third bullish candle to hold the gap without closing it. Once confirmed, a short position may be considered to take advantage of the continued downward movement. Now, let's discuss the bullish separating lines pattern. Structurally, this pattern begins with a bearish candle, followed by a bullish candle that opens near the same price level as the previous bearish candle and continues upward. This pattern signals that despite initial bearish pressure, buyers are regaining control and the uptrend may resume. The psychology is that sellers initially try to push the market lower, but buyers stepped in with enough strength to reverse the pressure. To trade this pattern, wait for the bullish candle to close above the high of the first bearish candle. This confirmation suggests that the uptrend is continuing and may offer a long entry opportunity. Next, we have the bearish separating lines pattern. This is the bearish counterpart of the bullish separating lines. It forms when a bullish candle is followed by a bearish candle that opens near the same price level as the previous bullish candle and continues downward. This pattern suggests that sellers are regaining control after a brief bullish move. The psychology is that although buyers initially pushed price higher, sellers quickly take control and signal that the downtrend may resume. To trade this pattern, wait for the bearish candle to close below the low of the first bullish candle. This confirms that bearish momentum may be continuing and can offer a short entry opportunity. Now, let's look at the bullish side-by-side white lines. This pattern appears in an uptrend and consists of two consecutive bullish candles that open at similar price levels. It signals a continuation of the upward trend because buyers remain in control. The psychology behind this pattern is that the similar opening levels show consistent bullish sentiment, with buyers confidently driving the market higher. To trade this pattern, wait for the second bullish candle to close. Once this confirmation appears, a long position may be considered with the expectation that the upward move will continue. On the opposite side, we have the bearish side-by-side white lines. This pattern appears in a downtrend and consists of two consecutive bearish candles that open at similar price levels. It indicates that sellers remain in control and that the downtrend is likely to persist. The psychology is that the similar opening prices show strong bearish pressure, with sellers continuing to push the market lower. To trade this pattern, wait for the second bearish candle to close. Once confirmed, a short position may be considered to follow the continued bearish momentum. Moving forward, let's explore the rising window. This is a bullish continuation pattern that occurs when there is a gap up between two candles in an uptrend. This means the second candle opens above the previous candle's high without overlap. The gap reinforces buyer strength. The psychology behind this pattern is that the gap reflects a surge in bullish sentiment, with buyers stepping in aggressively and leaving little room for sellers to challenge the move. To trade the rising window, wait for confirmation that the gap holds. Once the gap remains valid, it can act as support and may provide an opportunity to join the uptrend. Next, we have the falling window, the bearish counterpart of the rising window. This pattern occurs when a gap down forms between two candles in a downtrend, where the second candle opens below the previous candle's low. This signals strong selling pressure and a continuation of the downtrend. The psychology behind this pattern is that the gap reflects a sudden increase in bearish sentiment, with sellers pushing price lower and preventing buyers from closing the gap. To trade the falling window, wait for confirmation that the gap holds. Once confirmed, the gap can act as resistance and may provide an opportunity to enter a short position. In conclusion, mastering continuation candlestick patterns is essential for traders who want to capitalize on strong trends. These patterns provide signals that the prevailing trend may continue, allowing you to make more informed decisions and manage your positions with greater confidence. By recognizing patterns such as the rising and falling three methods, Tasuki gaps, separating lines, mat hold patterns, side-by-side white lines, rising windows, and falling windows, you can better time your trades, avoid false signals, and follow market momentum more effectively. Remember, the key to trading these patterns successfully is patience and confirmation. Always wait for the market to confirm the pattern before taking action, and use these signals as part of a broader trading strategy. With these tools in your arsenal, you will be better prepared to navigate both bullish and bearish markets and improve your overall trading performance. To wrap up, David Paul shares a powerful perspective on how professional traders often act after stop orders are triggered. This lesson about timing, liquidity, and confirmation connects directly with the use of continuation patterns.
The best trades occur after the masses have been stopped out. And markets tend to move. And that's because the big fellas up there, they can't press the wee button and get in, because there's just not enough liquidity there for them to get in size. So they have to, in fact, engineer 100,000 guys like you, sir. Pull you one way, your stop loss gets hit. That, in fact, sets off a sea of liquidity for them to get in. So even if you don't have the strength, or what I refer to jokingly as the testicular fortitude to buy at the level, if you can get in and you can see, using your cup here, you can see that lots and lots of people have been stopped out before you get in, then you're probably on the right side of the trade. The good trade's always the hard trade, always, but emotionally difficult. When it's time to buy, you won't want to.
So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.